Something big is breaking in the RV world, and it's not just prices. Sales are crashing, dealers are drowning in inventory, and used RV values are falling faster than anyone expected. But here's the scary part. This isn't just about RVs. It's a warning about the entire US economy. People are broke, credit is drying up, and the same cracks that appeared before the 2008 crash are starting to show again. Dealers are slashing prices, owners are panicking, and banks are quietly tightening up loans. If you think this won't hit your wallet, think again, because what's happening in the RV market could be the first domino. Here's how it started and why it's about to get worse. The economic red flag. The RV market isn't just tanking, it's sending a warning that the US economy is teetering. In 2021, Americans bought 600,000 RVs, a record fueled by pandemic lockdowns and remote work freedoms. Families and retirees saw these vehicles as escapes, while dealers barely had stock to meet demand. Fast forward to today, sales have collapsed by half. That kind of sudden reversal hasn't been seen since the lead-up to 2008, when RV declines foreshadowed the great financial crisis. Proof comes from the RV Industry Association's 202.5 report, showing the sharp drop in unit sales across all segments. For consumers, this isn't just industry noise. This is a signal that discretionary spending is tightening. People aren't buying RVs because they can't, not because they don't want to. And when discretionary spending falters, it ripples into housing, autos, and credit. Your wallet is on the line, and the timing of your next purchase or non-purchase could save or cost you thousands. The deeper question is why this boom collapsed so abruptly, and whether this pattern is about to repeat itself across other parts of the economy. Transitioning to the resale market, the numbers there tell an equally troubling story. Proof the economy is slowing. Used RVs are now dropping in value faster than most people expected. According to the Black Book Index, some models have fallen as much as 25% in just a few years. Dealer listings and recent auction receipts confirm it. A 203 Class C motorhome that sold for $100,000 2 years ago now trades for $75,000. And a 219 towable bought at $45,000 now fetches just $34,000. This isn't normal depreciation. This is a market in shock. The reason is clear. Too many units, rising interest rates, and consumer budgets stretched thin. For the first time since the pandemic boom, people are realizing that owning an RV comes with real financial risk. Owners are underwater, refinancing at higher rates, or forced to take cash losses. This is a direct warning about consumer behavior if people stop spending on high-ticket, non-essential items like RVs. It's an early indicator of economic stress across other sectors. Your wallet is effectively being tested. Your discretionary spending is being squeezed before wages and prices adjust. The resale data isn't just a curiosity, it's a predictive tool for what might hit your household budget next. Next, we move to inventory, pressures, and dealer pain, which amplify these warning signals in a way that will affect buyers, sellers, and the broader economy alike. If this analysis is helping you understand what's really happening in the RV market and why it matters for your finances, make sure to like the video, subscribe for more insights, and share your thoughts in the comments section now. Inventory, glut, and dealer pressure. Dealer lots tell a story the statistics only hint at. Across the country, hundreds of lots are now stacked with unsold 2023 and 2024 models, from mid-range Towabbles to motorized fifth wheels that once commanded strong interest. Dealer photos show rows of units parked side by side, sometimes extending beyond the designated show areas, proof of an oversaturated market. The surplus creates a direct financial strain for dealers. Floor plan loans continue to accrue interest. Staff overhead remains fixed, and holding costs eat into profit margins. The result is a marketplace where discounting becomes unavoidable. Incentives grow deeper, and any delay in selling units prolongs cash flow problems. For the consumer, this presents a mixed scenario. On one hand, it creates potential opportunities for strategic purchases at reduced prices. On the other hand, it signals that dealer confidence is weak, meaning they may push for rapid sales with less transparency about condition or past use. The interplay between dealer stress and buyer leverage raises the next pressing question. In a shrinking market, who bears the brunt? First, the dealer or the individual owner. The answer emerges as we examine the impact of financing in the current environment. High financing strain. Financing has become one of the clearest indicators of how this market collapse hits wallets directly. Monthly payments for standard towables range from $400 to $1,400 at current interest rates around 8%. While motorized units often exceed $1,500 per month under similar terms. Proof comes from sample financing sheets posted online by major dealerships such as Camping World, showing the breakdown of principal, interest, and term over 10-year plans. The high cost of borrowing compounds. The depreciation problem. Buyers may find themselves over-leveraged, paying substantial monthly sums for vehicles that have already lost a quarter of their value. This pressure can force tough choices, delaying other purchases, reducing discretionary spending, or in some cases, refinancing at even higher rates. For anyone considering, "Oh, I purchase now," understanding this dynamic is critical to protecting your cash flow. The stakes are clear. If payments are already straining budgets, the coming months could exacerbate financial stress, particularly if market conditions continue to push values downward. Up next, the story will move beyond individual finances to show how the collapse is sending signals across the entire industry, setting the stage for potential opportunities for informed, strategic buyers. Manufacturer stock declines. Winnebago Industries, long considered a bellwether for the RV market, has experienced a sharp and sustained decline over the past 12 months. Their stock has dropped 52% from the highs reached during the pandemic surge, reflecting both weak sales and looming inventory pressures across multiple product lines, including motorized fifth wheels, Class C motorhomes, and high-end towables. Proof comes directly from detailed stock charts tracking the company from January 2024 to December 2024. Showing a steady downward trajectory with intermittent volatility following each earnings release and market update. The impact extends far beyond investors. Employees at manufacturing plants are facing reduced hours, temporary layoffs, and delays in production schedules. While suppliers of essential components, from chassis parts and plumbing fixtures to cabinetry and electrical systems, also feel the strain as orders slow and contracts tighten. For the average consumer, this translates into fewer new units being produced, increased caution at the dealership, and potentially longer waiting times if production eventually recovers. The bigger picture is clear. When manufacturers falter, the ripple effect is inevitable, passing pressure down the chain to dealers, service networks, and ultimately to buyers who are navigating inventory constraints and pricing shifts. Next up, we'll examine how this stress spreads to related discretionary sectors and what it means for your local dealer's pricing and availability. Discretionary sector, spillover. The RV market's struggles are not isolated. Polaris, a company that produces sport utility vehicles, four-wheelers, and smaller recreational vehicles, has seen its stock decline by 60% over the last 18 months. Their Q4 2024 earnings report reveals weakened consumer demand across multiple segments, from off-road vehicles to urban leisure models. This demonstrates a broader pullback in discretionary spending money that would have gone to recreation is now withheld, often due to high interest rates and general financial uncertainty. Dealers who rely on cross-sales or additional purchases from R-vee buyers are affected as well. If a consumer is hesitant to buy an ATV or small vehicle, they may also delay R-vee purchases or accessories. For your wallet, this signals that the economic pinch is real and extends into areas that once felt untouchable, such as recreation and lifestyle spending. The question now is how these trends affect individuals who are already invested or considering an R-vee purchase. Next, we turn to real owner experiences that reveal the human side of this downturn. Owner stories and forum warnings. On forums like Reddit, RV owners are sharing first-hand accounts of financial strain. Many report being underwater on loans, owing more than their RV is currently worth, and facing higher interest rates if they attempt refinancing. Screenshots of user posts and discussions show specific examples. A 2023 Class C motorhome, purchased for $100,000, now has a resale value closer to $75,000. and the owner is paying $1,200 per month. Another thread documents a towable fifth wheel from 2024 purchased at $55,000, now listed for $39,000 on the resale market, with the owner forced to cover the remaining balance out of pocket. These concrete examples prove that the downturn is not just theoretical, it is affecting real people and real wallets. The consequence for anyone holding an R-vee or thinking about buying is clear. Financial risk is high, and strategic caution is required. The lingering question is whether anyone can navigate this market without taking a hit. Next, we'll examine how full-time R-vee living trends intersect with these financial pressures. Full-time R-vee living trend. Approximately 1 million Americans now reside in R-vees full-time, a figure supported by R-vee and census survey data. For many, this choice is driven less by lifestyle preference and more by financial necessity, as housing affordability has reached critical levels in multiple regions, particularly in states like Florida, California, and parts of the Mountain West. Images and reports of R-vee communities, combined with census statistics, indicate a steadily growing population trading conventional housing for mobility and cost reduction, even as the vehicles themselves continue to depreciate and financing costs remain high. Individuals choosing full-time R-vee living face significant financial implications. Ongoing depreciation erodes equity. Monthly obligations mount, and access to traditional credit lines or financial safety nets is often limited or restricted. Beyond individual risk, this trend highlights a broader economic signal. The market is shifting, discretionary income is constrained, and financial pressure is influencing major lifestyle decisions across age groups. Opportunistic buyers, savvy dealers, and secondary market participants stand to benefit from this environment, while those unprepared may face losses or cash flow challenges. Understanding who gains and who is exposed is crucial before committing to any purchase, as timing and careful evaluation can make the difference between saving thousands and being caught off guard. The next chapter will move from individual choices to actionable insights on identifying safe opportunities amid widespread market stress. Under 5,000 survivors and deals. Despite the widespread downturn, certain towables remain available for surprisingly low prices. Older models, particularly from 2018 through 2021, are being listed under $5,000 at auctions and private sales. Proof comes from multiple auction sites showing 2018 and 2019 travel trailers, moving at prices between $4,900 to $4,950, depending on condition. These are units that were once purchased for $35,000 to $45,000, now heavily discounted due to age, mileage, and oversupply. For someone willing to inspect thoroughly and focus on durable basics rather than brand new bells and whistles, this represents a rare opportunity to acquire an R-vee at a fraction of its peak value. However, timing is everything. If the right deal appears, hesitation can mean losing it to another buyer. Transitioning from raw deals to the underlying math, the next chapter shows how depreciation directly affects your potential savings and financial decision-making. Depreciation math in action. Understanding depreciation is absolutely critical for making smart moves in today's R-vee market. For example, a $100,000 motorized R-vee purchased in 2021 has now dropped 25% in value, meaning it currently trades for $75,000 on the secondary market. Proof of this comes from dealer pricing sheets and resale listings, where comparable units consistently show a significant gap between the original purchase price and current market value. The financial takeaway is straightforward. Buying at the right time, after the sharpest depreciation has already occurred, can save tens of thousands of dollars, while rushing into a purchase risks overpaying and facing immediate losses. This trend also highlights why early buyers are now at a disadvantage. Many finance their vehicles heavily at higher interest rates and are facing negative equity that reduces their flexibility. For anyone considering a purchase, the key question becomes which models have stabilized enough to avoid further dramatic value erosion and which continue to depreciate rapidly. Evaluating the timing, model year, and resale trajectory before spending your money is essential. Knowing this distinction protects your wallet and prevents long-term financial strain. Next, we examine the specific models that are currently too risky to touch and how avoiding them can safeguard your financial position in the market. Models to avoid. Certain 2023 and 2024 motorized fifth wheels are particularly risky. These units have high interest financing, heavy depreciation, and limited resale appeal. Proof comes from black book valuations and dealer memos indicating that these models, while flashy, are consistently selling below projected trade-in values and often require cash adjustments to complete a sale. A 2023 Class A motorhome that retailed for $120,000 2 years ago may now be listed around $90,000, leaving buyers exposed to steep losses if they attempt to resell. The wallet impact is immediate. Overpaying for one of these models today could tie up capital for years, with little opportunity to recover the difference. Understanding which models to avoid is essential for anyone trying to preserve financial flexibility in this turbulent market. Transitioning from risk avoidance to timing strategy, the next chapter addresses the critical window to maximize value on safer purchases. To stay ahead of market shifts, catch the next updates before prices change again, and subscribe to the channel. This is where you get the real data, alerts, and strategies that protect your wallet from hidden losses. Timing window. Inventory trends show that the next 30 to 60 days are absolutely crucial for securing meaningful discounts on both towables and motorized R-vees. Dealer shipment logs and detailed inventory reports confirm that lots across the country are clearing older stock at accelerated rates, often with price reductions exceeding $10,000 on larger units. Proof comes from real-time dealer listings, showing 2022 and 2023 fifth wheels dropping from $75,000 to $64,000 over the past month alone. For the consumer, the financial implications are stark. Acting outside this critical window could mean paying significantly more than necessary or missing out on the highest value units entirely. Conversely, waiting too long could leave you with only high-interest newer models or vehicles continuing to depreciate rapidly, which increases long-term financial risk. Beyond price alone, savvy buyers must consider factors such as condition, mileage, and financing terms to fully protect their wallets. The key takeaway is that staying informed, observing inventory movements closely, and acting deliberately allows you to capture the most value while minimizing exposure to unnecessary losses. The next step will guide you on where to look, what to verify, and how to approach these opportunities strategically, ensuring that your wallet remains protected as the market continues to shift and evolve over the coming weeks. R-vee market as economic indicator. The R-vee market has long served as an early warning system for broader economic trends. Historical data shows that when R-vee sales decline for 2 consecutive years, it often precedes a recession, as occurred in 2007 to 2008. The R-vee Industry Association's historical sales data confirms this pattern, with sales slowing well before other discretionary sectors felt the impact. For consumers, this is more than industry news. It is a direct signal about household budgets and discretionary spending. When people stop buying large, non-essential items like R-vees, it often reflects tight finances, rising debt, or declining confidence. The wallet implication is clear. If you see R-vee sales dropping sharply, it may be time to tighten spending on other high-cost purchases, such as home improvements, new vehicles, or luxury services. Understanding this early gives you a chance to protect savings, adjust budgets, and make informed financial decisions before broader economic forces hit. Transitioning from historical trends, the next chapter examines how the R-vee market collapse is rippling across other markets, amplifying the impact on everyday Americans. Ripple effect across markets. The downturn in R-vees is mirrored in housing and auto sales, both of which have weakened significantly over the past 2 years. Housing reports indicate lower transaction volumes and extended listing periods, while Polaris and similar recreational vehicle manufacturers report declining sales and reduced production forecasts. Proof comes from the most recent housing market reports and Polaris Q4 2024 earnings statements showing year-on-year declines of nearly 30% in some segments. This illustrates a broader economic slowdown. When discretionary spending contracts, income and savings are affected, and access to credit tightens. For the average American household, this can manifest as delayed vehicle purchases, postponed home renovations, or a reduction in leisure spending. Even those not directly in the R-vee market may feel the ripple as businesses in the supply chain adjust to reduce demand. Recognizing these cross-market effects is essential for protecting your wallet, as it signals which sectors are vulnerable and where to exercise caution. Next, we explore a protective strategy that leverages this knowledge to reduce risk and preserve capital. Protective strategy. Navigating this market safely requires focus, patience, and a thorough understanding of real value. The smartest approach is to wait for deals on reliable units, prioritize durable classics over newer, high-interest motorized models, and avoid overpaying for vehicles that are still depreciating rapidly. Proof comes from detailed depreciation charts and dealer financing examples, which clearly illustrate the stark differences between older towables that hold their value and brand new motorized fifth wheels that drop sharply in price within the first few years. By concentrating on models that retain value, carefully evaluating financing obligations, and factoring in monthly payments, trade-in risk, and long-term resale potential, you can minimize losses and protect your financial position. Ignoring these considerations can easily lead to thousands of dollars in out-of-pocket costs, particularly if interest rates rise or market conditions worsen. For anyone actively considering a purchase, taking the time to calculate depreciation, compare financing scenarios, and observe inventory cycles across multiple dealers can translate into significant savings and smarter decisions. The key takeaway is that disciplined selection, informed timing, and careful research are far more valuable than acting quickly or being swayed by brand appeal. Transitioning from strategy to final insight, the next chapter reveals the insider perspective on what to expect in the coming weeks. Insider takeaway and anticipation. Looking ahead, dealer bulletins, RVIA forecasts, and current inventory trends indicate that the market will continue to shift over the next 30 to 60 days. Certain models will clear at significant discounts, while others will remain overvalued due to financing pressures or low demand. Proof from dealer shipment logs and official RVIA forecasts confirms these patterns, allowing informed buyers to plan purchases strategically. For your wallet, this means that being aware of which units are likely to drop in value and which dealers are offering true clearance deals could save thousands of dollars. The final insight is that the market's next wave is already in motion. Prices, inventory, and financing terms are all shifting, and timing your actions correctly is critical. Missing this window may result in higher payments, slower resale potential, and less leverage when negotiating. Stay informed, track listings carefully, and act deliberately doing so ensures you capture value while avoiding costly mistakes. The market is moving fast, and those who prepare now will come out ahead while others scramble to adjust. So, what do you think? Is the R-vee market just collapsing? Or is it warning us about something much bigger? Drop your thoughts in the comments below. I read every one of them. If this opened your eyes, hit that like button, subscribe for more real updates, and stay tuned, because the next wave is already coming.